Today, we will talk about IRS Publication 527, Residential Rental Property. IRS Publication 527, Residential Rental Property, is a document published by the Internal Revenue Service that provides tax information for individuals who own residential properties that are rented out for income. Typically, all income earned from rental properties is reported to the IRS, though the type of rental activity will alter which sections of the tax form that income is reported. IRS Publication 527 outlines how to account for property depreciation, what types of deductions can be made on rental income, as well as what to do if only part of a property is rented. IRS Publication 527 is composed of 5 chapters of tax instructions that detail everything property owners need to know about the tax consequences of renting out their second homes, including the deductions that may be taken. Taxpayers should consult Publication 527 before renting their homes in order to learn how rental income is treated by the IRS. The IRS considers rental income as any of the following: normal and advance rent payments, payments for canceling a lease, and expenses paid by the tenant. Advance rent is any amount paid by the tenant before the period that it covers. If a tenant pays to break a lease, or forfeits their security deposit, the amount received is considered rent and must be included as rental income for the year it was received. While many property owners assume that generating rental revenue will lead to a surplus of income, they should be aware of the multiple ways they're able to incur a tax loss on rental activity due to things like interest payments and depreciation. Property owners are normally not allowed to deduct a tax loss, because renting out a second home is usually considered to be a passive activity. However, owners who assume a hands-on role in managing their rental space may consequently deduct up to $25,000 of tax losses. Taxpayers are allowed to deduct the following expenses from operating a rental property: home mortgage interest, mortgage insurance premiums, real estate taxes, depreciation, as well as other expenses that are normally non-deductible personal expenses, such as expenses for electricity or painting the outside of the house. Here are 3 key takeaways. 1. IRS Publication 527 is a document used to provide details and instructions for those who rent out their residential properties for income. 2. The IRS considers rental income as any of the following: normal and advance rent payments, payments for canceling a lease, and expenses paid by the tenant. 3. IRS Publication 527 gives instructions on how to account for property depreciation, what types of deductions can be made on rental income, as well as what to do if only part of a property is rented. Hope this would help. Thanks for watching.